to successfully develop a serious business, you need a process by which to obtain that information, and once obtained, a method by which to put that information to your use productively. Everything else is simply process and method. So when we start coming back to trading, how does this all relate to trading, people might ask, John? Well, this comes back to having a way of finding exactly what you're looking for when you're trading. So how do most people make their decisions, though? Most people make their decisions from not from direct quantifiable methods, but from stories. And you know, the news, friends, newsletters, not that there's anything wrong inherently with any of these things, but on their own can be very dangerous. Things you're familiar with, that's a picture of where we are up here in Vancouver. So the problem with that is that's what leads most to mistakes. We fail to limit losses, we average down, we buy into emotion, we believe in public information. Yeah, Michael Gerber, that's exactly right. Selling on pullbacks, taking too much risk. And that's why people lose money. It's because we're basically investing emotionally and we lack a strategy. And very simply put, that is not very surprising with all the noise. We're dealing with a scenario where you're constantly being bombarded with things that make you feel a certain way and react a certain way. So the question that I pose to everybody, again, this can go for any kind of trader that you are. If you could take a pen and paper, if I gave you one right now, if you were to draw out exactly what you want a stock, a future, a whatever, even an option, exactly what you want that chart to look like when you would buy it, what would it be? Okay, so forget the conditions. The conditions don't change that much. You know, I could be looking for a long, and I could say, all right, I want a low P to E ratio, a low price to book ratio. I want the, you know, the gosh, utilities just broke out today as a sector on the sector spider. So okay, gee, I want utility stocks. Okay, and I want them to have an earnings per share next year of 50% growth. I want there to be, you know, all these conditions, these types of background information. I want there to be institutional buying happening in the last 6 months. I want there to be insider transactions increasing over the last 6 months. And by the way, these are all things you can build out easily in any kind of scanning program. Look for these conditions. Now, what these conditions don't do, though, is they don't tell you anything about timing. Because if you take a stock that goes from 5 to 9 to 5 to 4 to 2 to 5, you know, all of those conditions are still the same. They're still in the same sector. The price to earnings ratio might change a little bit, but it's going to stay around the same amount. The management will still be the same. What they do will still be the same. So conditions don't give us any kind of idea of when price is right. So all the things we hear about in the stories don't help us time our investments. And timing is everything. Ask the guy who bought Apple at 700 versus the guy who bought it at 300 to tell you the importance of timing. So, or girl, I suppose. So we need to actually have a quantifiable way of saying, all right, with all the conditions, what exactly do we want, if those are right, the chart to look like in order for us to make a decision to buy? So the problem is most people don't have that. Time projections, crystal balls, yeah. Well, you know, we'll talk about some ways that maybe aren't as effective as that, but very close. Ways to see what the real money is doing behind the scenes. But most people don't have any kind of strategy. They jump from strategy to strategy. How many people in the room have a strategy, a very exact strategy that they follow? And how many people here kind of have multiple things that they're bouncing around between? Because I find most of the people, yep, okay, not too defined. You see, the problem is as I said, if you don't know where you're going, any road will take you there. And the importance of having consistent strategies is just like a business. You want to, again, there's a lot of similarities. We want to have a consistency to knowing where to buy and sell and how to replicate that. So the only value in a good trade is if we know how to replicate it 100 times more. The only reason a trade is a real loser is if we don't learn how to not repeat that mistake. So let's go back to some fundamental questions, and this will tie in, I think, well. I caught the last half of the last presentation, and I heard the gentleman speaking about levels, Kai speaking about levels. Levels are very important because what we really need to ask is who controls the market? Well, volume controls the market. Volume dictates price. So who dictates the volume? Any guesses? Who dictates the volume of the market? Buyers and sellers, yes. Nalga controls the market, okay. We should talk later. Naga, sorry. Buyers and sellers, players, supply and demand, all correct. Smart money. Just if you go back 4 years and watch the 60 Minutes interview on high frequency trading, if you go back and look at the subscribers to the Nasdaq's news service. The Nasdaq's news service, when it was released 3 years ago, I think, has something like 65% of its subscribers were computers, not people, but computers that read the news. 4 years ago, they estimated, in fact, that 70 to 80% of all the trades that happened in the market were actually accounted for by computers. So that doesn't mean you and I sitting there deciding if we're going to buy and sell. What that means is I'm talking about banks and floors of computers that are pre-programmed to buy and sell based on rules, or more importantly, patterns. Do this when this happens, do that when that happens, based on algorithmic functions, right? Billions of dollars made by, in fact, one fund they interviewed, I think, in the 60 Minutes session, they said that they hadn't lost money, I believe, in 16 months. Unbelievable. So if you think back to the flash crash of 2010, it wasn't that long ago. Yeah, exactly. Programmed by PhDs, quantitative analysts, not traders. In fact, some of the people that manage these billions of funds had never traded a stock in their life when they were hired. There were stories of poker players who'd won poker tournaments out of thousands of people hired for million-dollar contracts. Why is that, might you ask? Well, we're going to get to that. But let's start with the flash crash of 2010. In the flash crash of 2010, who was trading the market back then? Does everyone remember this? Basically, the markets crashed an incredible amount, over 1,000 points on the Dow, in a matter of minutes. And after it plunged that amount, it hit some magical floor and rallied straight back up. Billions of dollars changing direction. Let's think about that for a second. That's like a Mack truck with towing 10 other Mack trucks behind it, going 150 miles an hour on a highway, and then coming to an immediate stop, turning right around in 180 degrees and going the exact same speed in the opposite direction. That's almost impossible. To do that, you would have to have some kind of incredible power. What kind of power? The kind of power that when you control 70 to 80% of the market's volume, you can perhaps have. So these forces that control the market, though, are also very predictable. But just before we go further on this point, I just want to say something, because often when I say, hey, the market's controlled 70 to 80% by Goldman Sachs and JP Morgan and blah, 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 people say, well, does that mean that these guys have 70 to 80% of the money? No, it doesn't mean that. But let me put it in this regard. Let's say everyone in this room has $1,000, right? You've got hopefully everyone's got a lot more than that. But let's say everyone here has got $1,000, and that's 343 people here right now. Thousands more listening. So, but let's say 343 people. Everybody here tomorrow buys $1,000 of stock XYZ. Okay? Was the flash crash predictable? We'll talk about that. So everyone buys $1,000 worth, so everybody buys and holds. That's $343,000 in volume, right? So let's say that I come in and I've got $1,000 as well, right? But I trade, I buy and sell with my $1,000. So I buy and sell, so I account for $2,000 of volume. And instead of buying and selling once, I do it 100 times. So now I represent 200,000. So let's say I did it 1,000 times. Now my $1,000 represents 2 million. So with $1,000, I represent a significant amount, much more than 343 people do with the same amount of money, of the volume. And I can do that by high frequency trading, getting in and out 1,000 times. Or another term for it would be death by 1,000 cuts. So that's what I mean when I say 70 to 80% of the market. Let's push forward. The algorithms make these decisions by looking for predetermined rule sets. And you know, if you think that we're safe from this type of thing happening again, well, just remember what BS we were kind of spoon-fed back when the flash crash happened. What did they say to us? The big B finger, the big fat finger complex. Rubbish. I highly doubt that the entire market crashed because someone fell over their keyboard. Just like I find it highly improbable that the NASDAQ was shut down for half a day because someone tripped over the electrical wire. Really. You know, we have a very interesting market, and when you can see things like when Knight Capital, another high-frequency trading firm, put in a bogus algorithm and lost huge, inordinate amounts of money in a matter of a couple of hours, I think it was, it got shut down, a record amount of volume vanished from the New York Stock Exchange the next day. I think it was the lowest recorded amount of futures traded on the New York Stock Exchange that wasn't a holiday in the last 50 years or something like that. That's crazy, you know. So the power is amazing. So what we need to do is we need to asking ourselves the question: when we're looking at the stock market, who do we really need to be watching? Do we really care what Joe Bloggs next door is doing, or do we really care what the smart money is doing? Because yes, people and people's reactions could cause a 5 or 10% blip in a stock. Yes, a stock might trade back and forth in a range, and individual traders can take advantage of that. But what I'm far more interested in is when the elephant steps into the bathtub. Right? I want to know when the highly probable moves, massive amounts of supply or demand are supporting it. So in order to do that, we need to start defining some things. And this is where we kind of start getting into the fun stuff. Okay, we need to say, well, firstly, what moves the market? Well, and what I'm going to talk to you about tonight, or continue talking to you about tonight, is not specific to just trading stocks. In fact, I'm going to share with you some of the recent stocks that this strategy has found, as well as options. Because it's, if you understand how a stock moves to a very high level, you can make obviously a lot more on the option. But that's an extension of understanding how equities move in the first place. So let's start with just talking about equities in general. A stock, in my opinion, will never really change direction until it hits one of three things. Horizontal support or resistance, a trend line resistance, or moving averages. So when we start talking about the market flash crashes, or things like that, algorithms don't see this. They don't see candles. They don't see days, months, or minutes. They see price. Right? They see price levels. And that's why a market can crash 6 months worth of growth in a matter of 20 minutes, because the market's not reacting to what day it is or who's at lunch. They're just simply looking at where the market is and where it's programmed to react. So what they actually see is this. So imagine a children's coloring book. You know the ones where you give the kids the crayons and they color in between the lines? when you look at a chart, or when I look at a chart, I'm thinking of it as that children's coloring book, but instead I can see the coloring in, and now I need to figure out what the lines are that they're coloring inside of. And these are what I'm trying to find. And my job then is to find the most important ones. So let's come back to the flash crash of May 2010. In May 2010, the market rallied up from this specific point. I'm not sure if you can see this on your screen. It's around 1060 on the Dow. Rallied up to around 1220. Came down and sat on this shelf of support around 1180. What then occurred is it broke this key level with volume, and had this, and you could even call that a head and shoulders if you wanted to get into it. So you started to see this pattern. It broke through the support and then had a very quick and catastrophic drop that triggered a domino effect for everything to start selling. Think about a breakout. Think about a flag formation. When something breaks a horizontal resistance point with enough volume, it can trigger moves in stocks of 10 to 20 to 30 times the volume and have 20, 30, 40% moves. So just think about that, but in the downside on the S&P and the Dow. It triggered this global sell-off. And where did it go to? Where did this catastrophic drop so happen to change direction? Right at the same point that it had rallied from after a similar kind of catastrophic drop from a similar level back here for pre-January. Okay, so let's make sure everyone can still see the screen. Okay, good. Paul, you may need to disconnect and hit the blue X button and then click reload if anyone has any issues. So let's push forward. So it dropped and then rallied straight back up. Now, where did it rally to? Rallied straight to this resistance level. And I remember a gentleman talking on CNN actually that very day that the market dropped. They said, "What do you think of the drop?" He said, "It's a gift from above." What we've just seen today is exactly where the market intends to buy and where they intend to sell. So why, again, just those of you asking why stocks change direction, because they hit something, a horizontal support resistance, a moving average, or a trend line. And in this case, it was a horizontal level. What ended up happening, if you look at a lot of major stocks, if you look at things like TD, Toronto Dominion, TD is a symbol, you'll notice that the level that it bounced off here and here actually became one of the major points it bounced off for the next 2-3 years, because it was a preset point where the algorithms are set to buy and sell. And this is the thing that I care about. I don't care what all this noise is in between. I want to know where the major market direction changing moves will happen, because that's when the big money, the money that matters, is going to step in. And that's what I care about. So in general, 90% of the chart I'm not even interested in. You could show me 100 stocks and say, which would you trade? Probably out of those 100 stocks, there'd only be a couple that would even be half worth looking at, which raises the question, of course, how do you find good trades? And that's what this is all about, how we find this perfect storm. What is the horizontal level regarding which stock? The S&P? I'll let you fill that out. So in the meantime, what I'd like to talk about here is the most important thing I want to do when I look at a chart is I'm not looking at a chart of a stock, of an equity, of a foreign exchange. What I'm looking for when I look at a chart is where is the high probability level? Where is the highest probability level that I could take a long or a short with a high degree of confidence that the big money will be doing the same thing at that price? And if the stock or the foreign exchange or whatever I'm looking at is not close to that level, then I don't trade it. Even if it's in a head and shoulders pattern, even if it's in a ascending triangle or a descending wedge or a triple top or a scalp or a saucepan, whatever. The most important thing is that it's at a very, very strong high probability level. So we'll switch through and have a look at some live stuff here once we've in a minute. So if there's some things you want to bring up and have a look at, I'm sure we'll find it quite interesting. And I'll show you some stuff we've been doing just these last few days. The first step, though, is to find these levels. And what we're looking for, I'll just come back actually before we go to that. What we're looking for, firstly, when we look at these levels, is we're looking for the way that something bounces. Let's just grab a pen here. So when a stock comes down, let's have a look. The pen. Have a quick look at which. Oh, here we go. I'm looking for this. All right. So when we actually see a stock dropping, we want to look at the power of the level. So we're looking for the presence or the fingerprint of when the smart money buys. So if we have a dramatic rally, that's far more valuable than if we actually have something come down and just bounce around. That's retail, it's consolidation. Not so interested in that. So what we're more interested, so I'll give you a bit of a test. We'll go to the next screen. Just a quick survey of the audience, if you will. If we were to actually look at these 4 options, let's say that this is the stock that we're looking at. This is what the chart looks like when it comes up in a scan. And we have a few choices. We can wait for it to get to A and short it. We can wait for it to go to B. Excuse me. Yeah, we could wait for it to go to B and short it. Or we could go long at C. Or we could go long at D and hope it goes down there. If you had the choice, which would you do? Would you go short at A, short at B, long at C, or long at D? I love this question, by the way, because it gets everyone to all the different opinions to come out. That's great. Well, there's a lot of great divergence in the answers. Short at C. All right. Well, let's talk about this a little bit, because this is the fact that we have such a range of answers shows the diversity of trading opinion. And I'm not going to come and say that anyone's right or wrong, but I'll tell you what my experience and opinion is. In my experience, what I'm looking for is the highest probability trade. So A hasn't been tested yet. A hasn't been tested yet, so there's no evidence that anything will happen there yet because we haven't seen the smart money show its cards. B has been tested twice. Once, twice, 3 times a lady? Once, twice. So, and what kind of moves have we got when it hits it? Pretty pitiful, just a tiny drop. Let's say that represents 5%. So it's been tested twice, and it's only dropped a little bit. If the smart money was selling the hell out of their position, would it just drop a little bit? Probably not. And also, another thing you should be aware of is that the more times a line gets tested, the weaker it becomes. So if you get a little, think of it like a rock hammer tapping away at a glass window. Every time you hit that glass, it's going to become weaker and weaker. So what I'm essentially looking for is a level where it has not been tested, ideally more than once. And when it tested it that one time, I want to see a dramatic move. So for everybody who said long at D, that would be the one I would have been going for. I guess the other option you could be looking for is a third option. to go short at E. I'll just go that on the chart. That would be my second option. The reason why is because it's fresh in the sense it's only been hit once. Powerful because it drove through 1, 2, up to 3 levels. So it was a powerful, fresh level. And E would be the second, so that would be the second most powerful because it dropped dramatically as well. Also only been tested once and dropped 2 levels, stronger than everything else. So this is kind of the way we, obviously what would now help us is to see the volume of what actually volume kicked in at these different levels as well. Price at volume indicators. You could see that kind of some of the previous slides, looking at what kind of volume comes in at prices. Again, detecting where forceful moves can happen. And the normal comment I get here is that what if it never came down to D? John, if D is the level, what if it never came down to that? And I saw a question scroll through earlier that I didn't have a chance to answer, but it was, what is the frequency of your trades? And if I can be so confident to guess what the behind meaning was, that is that if you're looking for such a strong, perfect level that 90% of the trades don't interest you, how many times do you find a trade that you do get interested in? Well, here's the thing. Building a shopping list for your trade is so important. If you were to go out and go buy a house, right? And you've got 3 kids. So you say, all right, what do I need in this house? I want 3 bedrooms. I need a car garage because we've got 2 cars to drive the kids to school in, and soccer practice and things. We need air conditioning because we live in Texas and Arizona and it's damn hot in the summertime. We need, we've got 3 dogs, so we need a big backyard. Okay, so then you go out with your real estate agent. You have this list of must-haves, and the first thing he shows you is a caravan. Do you come back with it because it's the only thing he has to show you for that day? Do you buy the gutty caravan and take it home because it was the best thing, it was the best of the worst? I hope not. People do it all the time with stocks though. How many times I've had students come to me and say, John, I ran my scans tonight, I couldn't find anything that met the strategy. What should I do now? My response, don't do anything. It's telling you there's no good trade. Okay, so we should have a checklist, a shopping list for what we want when we buy or sell a stock. So what do the bigwigs watch? Well, the interesting thing about time frames is that it's a little bit like the Russian dolls. Every time you open one, you find the same thing but smaller. And trading is very much the same, which is why the strategies work on all different time frames, because there is so much you can do on these different time frames. But it all comes back to looking for the powerful ranges. And so if it never comes down to D, I'll never trade it. I think that's the important point to get across. But by knowing what the perfect storm is, I don't have to trade this. In fact, if I never trade this stock ever, and let's say it's Apple, and let's say I never trade Apple because it never becomes a perfect storm. Well, I've got thousands of other stocks I can trade. I'm not locked into trading any one stock. So another thing, by the way, why am I looking for fresh levels? Because the more time something has happened, the more obvious it is. The market makers do not make it easy for retailers to make money. Okay? Here's one little more analogy before we get back to the technicals. And I'm sorry, I hope this helps. But let's talk about football. When I came across from Australia to the US, I lived in the US for several years, loved it. And but one of the things I had trouble with was understanding football for the first time, as I did with hockey. I thought hockey was ice boxing when I first saw it. But anyway, when I saw my first game of football, I remember watching and I just could not get it. Like the whistle would blow and all these men dressed up in padding would just run across the field at each other. Every man for himself, I thought it was, and then some other players would be running back back to the field where other team members were running forward. I thought, what on earth is this game all about? I didn't get it. And then I started to see, yeah, go the Hawks. So then I then started seeing that as they played on, there was actually a purpose to this madness. It wasn't just unorganized chaos with people running at each other. They actually knew exactly where they were going. And as I started to think more about this, and the more times I saw certain plays happen, the more I realized they were similar. And there was actually a pattern to how these players would run and where they would run and when they would run. And then as a trader, I immediately thought, well, isn't this like the stock market? You know, because in the stock market, there is all these hundreds of patterns, like ascending wedges and things like that. And out of all these patterns, the coach is the market maker, right? The smart money. And what they're doing is you are the other opposite team, as well as the other market makers they're playing against. But basically, the job as the market maker is to change the play. Because what happens if you are watching if you're watching football and the coach played the same play again and again and again and again? What would happen? If the coach kept playing the same game, same plays, you'd lose. Where I live in the States, by the way, I lived in California for a while, lived in New York for a while. I kind of was doing freelancing, trading, and traveling for quite a while. Yeah, so this is the kind of thing that I say. Is you've got to look at what the plays are. Now, when we look at the stock market, we're looking at the powerful plays. So this is the next thing I want to show you. What happens if you're looking at charts like this, when we're trying to find the high power trades, and you see this is a double top, two double tops. We've got double top A and double top B. Which is the more powerful place to short, A or B? B. Great, exactly. Why? Because despite this one having higher lows, this is actually a much more significantly powerful trade because of the sharpness of that reaction. A is retail, B is smart money. All right, let's keep pushing forward. So smart money. Let's just summarize. In order to move the market, the smart money has to agree. No matter how much research you do, if the market doesn't agree, you might be right, but you'll still be wrong. You'll still lose money. If you do all the research in the world and find that this stock XYZ is the gem that everyone's looking for, the next Microsoft, and it's $10, so you buy it because you're a genius and you're smarter than everybody else, but no one else knows that. In fact, everybody else doesn't agree with you yet, and so they're all selling. And the market maker, well, you know what? That's great for them because maybe they do know the same thing as you, but they're looking to buy it at $2 because they're capitalists and they want to make the most amount of money. So the more people hate the stock, the better for them if what you think is true. And so you buying it at $10, watch it go to 2 and causes you probably an early aneurysm, and then it finally goes up. So what's more important, being right or knowing when the smart money is getting in? I would argue it's both, but being right and then timing that with when the smart money buys is a very powerful combination. So let's look for the checklist. Method is to sort out the smart money? Yes, that's part of it. We want to know when the powerful levels are, which is generally caused by smart money. Smart money being the hedge funds, the high-frequency trading outfits, the Goldman Sachs, the JP Morgans, but those that provide and control the volume. So when we're looking for a smart money checklist, here's an easy pilot's checklist you can use for any kind of option or stock play. Firstly, make sure that we're looking for correlating trades with the market. Correlating trades mean that if we are looking at a market that is set to break out, let's look for longs. If you're expecting that the S&P will hit this overhead resistance and bounce down, then let's find stocks that are at resistance of a heavy selling resistance level. If we're expecting the stocks to break out, then let's look for stocks that are setting up for a flag formation or an ascending triangle breakout. Let's look for stocks that would correlate well with what we anticipate the market's going to do next. Now, if we want to make this even more high probability, let's then correlate that with sectors. So if you want to look at market sectors right now, you can see that there is a distinct difference between ones that are doing really well and strongly versus others not doing so well. So utilities just broke out of a consolidation triangle by today. Money flow on the tech sector is out of control in a positive. But if you look at basic materials, for example, not doing as well. So you start to see not what the strongest sector was last week, but what is going to be the strongest sector tomorrow. And then we can narrow our field. And then finally, once we've narrowed it down to there, we then look for the high probability zones. So we're looking for previous strong levels of buying or selling, fresh levels, and powerful levels. I'm just going to go back to the question board here for a second. So how do they simultaneously hedge with the same amount of capital? There's a lot of ways to hedge. And the way they do it simultaneously is through calculated algorithms. So let's say that, just give you an example, let's say financials go up 1%, and stock XYZ in the financials goes up 5%, and stock 2 goes up 0.5%. That means that stock 2 underperformed the sector by 0.5%, but the other one overperformed the sector by 5%. So you have a difference that even though the water level, for example, went up 6 feet, the boat in it only went up 3 feet, which actually means it's sinking, right? So there's a number of ways you could hedge that. You could go long the first stock and go short the second. Just a couple of interesting things. We'll talk more about that depending on how much time we get at the end of the session. So let's start to talk about high probability zones. This is a trade that we picked last year, actually, but it's a great example because it's on the Chicago Board Options Exchange. And I use this example, just like the flash crash, to show you how major markets react to these. So CBOE, right? CBOE, up back here in 2011, came up to this level, I think it was around 30 bucks, and shot straight down. Straight down. Rallied back up, created a lower high, and did exactly the same thing again. That could not happen unless big money was selling, waiting to sell and short. How do you identify trend? We'll come back to that. So the second thing, what I was looking for then, this had hit once, twice, so I'm waiting for this third time for it to hit, and it happened about 16 months later. And the moment that happened, I was ready weeks beforehand with alerts set up that now was time to short. So if you're a swing trader, this is the kind of thing where you can have a short sell set up days before with a stop loss, a profit target, an entry level, and you don't even need to touch it. If you're using a good enough brokerage system, it'll do all of that for you, send you emails and text messages letting you know that it has, and then tell you within the next few days whether you've made a profit or a loss. That's what trading is in my mind, even if you are day trading, is to have you manage your strategy and let your strategy manage your money, just like a business. I don't want to work in my business. I want to run my business, right? I don't want to do the admin, the accounting. I like coaching and running the company. Same thing with your trading. I like developing strategies and letting them go to work and watching the strategy make me money. That's what trading for me is about, right? So everyone has different motives, but that's the idea for me anyway. So let's push forward. So when it came to this level, it was an ideal short for this criteria, and it plummeted right down after hitting that strong smart money level. And by the way, just before we go forth, look at where it bounced down to. The same price that that entire move came from. So the meaning of the above chart, Joe, is, yeah, I can mark these levels. So this is actually where the yellow line is that I'm talking about here. So yeah, I'll just highlight that a bit better. That is the smart money short level, and that's the smart money buy level. So all of this stuff in between, the entire time, whoops, ooh, what's going on there? Hang on. There we go. There's the short, there's the buy. So everything in between this entire time, I was ignoring this stock. I wasn't interested in it. I was waiting for it to get to a high probability level. So I built my scans out to let me know when this got hit. So again, let's come back to the next symbol. So once we have looked at the chart and we identify a smart money level, a distinct strong pattern where something is highly probable to happen, we then want to increase the probability of that by going and looking at indicators that will confirm our ideas. So looking for signs of oversold and overbought, looking for signs of heavy volume to occur at these levels, and confirming with price action tools such as Bollinger Bands. Now, Bollinger Bands is something that's been commonly used, but often not effectively. Who here has used Bollinger Bands in the room? Who's used Bollinger Bands by way of a yes? Who hasn't by way of a no? They're similar to Keltner channels and things like that as well. Now, most people use these as an indicator. Well, I mean, there's tons. Some people look at when they go outside the Bollinger Band, the top Bollinger Band is a long. Some people look at when it goes out of the top Bollinger Band as a short. Some people look for when there's a squeeze. If all of you who've used Bollinger Bands, if it's one of those three, just throw in the chat window which of those three it is. Whether if it goes above the Bollinger as a short or a long, or if you look for the squeeze. But again, perfect storms, we need to know what we're using it for. In terms of a trading the extreme strategy, just like what I showed you with CBOE, what we're looking for is we're looking not for the squeeze or what happens inside the Bollinger, but more interested in what happens outside. Because 95% of the stock's movement will be inside the Bollinger. And think of it this way, if I spent 95% of my time in this office, like I have today, and I went outside and someone came looking for me here, and they knew that I spent 95% of my time inside, what would be the smart thing to do? To wait for me to come back or to go looking for me? It would be to wait for me, because there's a 95% probability I'll be right back soon. So when I see a stock go outside of the Bollinger, I'm thinking, right, it has to come back because that's where it spends 95%. Ryan, my office sometimes follows me around, not the Vancouver office though, it's a bit too much concrete. But Bollinger Bands, therefore, are one technique I'm going to show you to apply, which you can immediately go away and apply to anything. The next thing that we want to then do, excuse me, before we pitch on there, here we go, we've got the Bollinger Band. One thing to notice here is you've got to look for when the stock is outside, just to point out these key points for anyone who hasn't used these before. What you'll notice is that when it goes outside here, 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 all these scenarios where it goes outside, you'll notice it actually has a sharp change in direction. And Bennett, price action is absolutely important. In fact, if you don't know what trade you're doing before you even look at an indicator, it's useless. So I agree with you. Tim, have we picked up a stock where Bollinger Bands have not set up as good? Yes, in a different strategy though. And actually I'll share one of those stocks with you here in a moment, which was our pick on eBay as a short just a few days ago. I'll share with you how that panned out and why we picked it. But before we go into that again, once we've got the Bollinger Bands, so let's say that now we have the stock is at a really strong resistance point. So we think that the smart money is really prevalent here. It should react as it goes into that zone. It's going to get slammed up or slammed down. We find that it's outside of the Bollinger Band as well. So it's outside. That elastic band has been stretched as far as possible. And now what can we do to enhance that probability even more? Now we can look for chart patterns that are bearish. So as the stock approaches maybe a double top, maybe it's approaching that double top in a rising wedge. So we're approaching a bearish pattern here with a bearish pattern. So maybe on the daily chart it looks like that, and on the hourly chart it looks like this. So we look for bearish signals and bearish patterns, as well as bearish indicators with bearish resistance, and the more and more we add, the higher the probability our trade becomes, right? And does every good trade meet all of these? No, but a lot of bad trades don't. So again, this is our checklist, looking for signs of oversold and overbought, heavy levels of volume, and price action confirming using Bollinger Bands. Okay, now let me just have a quick look here. Okay, so understanding the probabilities of how this all fits together is very important. And what we finally then usually put on as another checkpoint is looking at money flow. All right, now there's many methods of money flow. There's chalk and money flow. There's money flow index. The one I use is similar to money flow index and chalk, and it's called the Twigs money flow. But in fact, if anyone who uses Metastock, there's some excellent money flow indicators in Metastock. It's one of my key programs that I use, and I know that they have basically a fantastic wardrobe of all the things that we look for in setups for trades. So when I go into, I program this money flow indicator that we use. There's an algorithm which I'm happy to share with people for the money flow that we actually use, and it can be imported into Metastock and other programs too if you want to code it. So I'm happy to share that with you. If you want that, the coding for the money flow indicator we use, it's very powerful. You can just email me at john@acornwealthcorp.com, and I'll fire you back that code for the Metastock setup. But this is, if you see money flow, one of the key things we look for is we look for divergence. So on that Chicago Board Options Exchange, you'll see here that price went up and money flow went down. Now, money flow is powerful because it really tells you the sentiment of the stock. Because most people think, well, okay, let me track back for a second. Let me ask you, everybody, what is the definition of an uptrend? What is the definition usually of an uptrend? Higher highs, higher lows, exactly. Higher highs, higher lows. But is that really true? Because surely, if the stock was doing this, right? If the stock was going higher highs and higher lows, but contracting in its range, wouldn't that be a rising wedge? And wouldn't that be bearish? Let me throw another situation at you. What if the stock was going up in price, but volume was going down? You know, what if I sold pens for a living, and I sold 1,000 pens at $1 today, and tomorrow I sold 2,000, I double my prices to $2, so 100% increase in price, but I only sell 100 pens. Well, on the first day I make $1,000. On the second day, I make 400. I think I did the math right. Anyway, I make a lot less. So price, it can be very easily manipulated, and it's how most traders get manipulated into bad trades. Why most people buy breakouts only to find them fail on them the next day, because the market maker pushed price up with a small amount of volume to stop people out and to get people to buy into that price action and then slam it down the next day. But if you'd looked at price and volume, probably would have told you a different story. So What we want to do is we need to find a way to marry this data together and say, what is the smart money thinking? What is it doing, right? And money flow, especially the formula that we use, it's a tweaked, very special formula. And what it does is it looks at the price. It also looks at the volume. And finally, it also looks at where the stock closes in the range. Because the third thing that it could also happen that I hadn't drawn was this. The third thing that could happen is the stock could go up, higher highs and higher lows, but on the first day it could close like this. The second day it could close like this. And the third day it could close like that. Is that a stock you'd buy? I hope not. That's a very indicative pattern of reversals despite the higher highs and higher lows. So we need to also take into account where it closes in the range. And because that's a lot to comprehend, maybe for a new trader, maybe not for many of you who are more advanced, but one easy way to do it, no matter what your experience level, is to combine it into a money flow indicator. And this is one that does it. Does it really well, combines all three things and tells you what the smart money sentiment is. Is it flowing in or out? So on CBOE, and I saw that stock outside its Bollinger and at a heavy level of resistance where the smart money was just kind of cupping their hands ready to push the sell button, and saw money flow telling me the exact same thing. I got a perfect storm. And there is your money flow bringing it full circle. And as was pointed out earlier, poker is a great analogy to use when talking about this. So you want to talk about a perfect storm. I'll tell you, one of my colleagues here at the office in the customer relations department he's been playing in a poker tournament for the last 6 months, and he got to the final table yesterday. And if he'd won, he would have got a seat at a tournament that I think was a 36,000 or 56,000 or something buy-in just to sit there. He would have won a free seat. And he was at the final table last night, and he had a ace-king suited. And you know what beat him and took him clean out? Was a 5-2 unsuited. Terrible hand, because the dealer folded over a 5 and 2 2s, and the guy got a full house. Right? So the reason I raise that out is because can any hand win a game? Yes, it can. A 5-2 unsuited won that one. But how do you make money long term? You don't play 5-2s. You know, and the same way with a stock. Just because every hand can win doesn't mean you play every hand. And just because every type of pattern or strategy in the stock market can make money doesn't mean you should trade it. The trick is to find what the high probability hands are, to know what type of reward is in the pot, and to know what kind of risk you're taking in order to get it. And if all of those things are aligned, the risk and reward, the high probability hand, and knowing who you're playing against, then you've got a perfect storm. And that's what we need to do in trading, knowing all these variables. So when we go into these things and we build scans, we need to make sure that we're building scans that look for these high probability zones by knowing exactly what the trigger is. So in other words, what has to have happened today? So yesterday, it was a terrible stock. Tomorrow, it's too late. What happened today that in this very time-sensitive moment, it's an opportune, perfect time? You got to know exactly what that trigger is. The next thing you need to know then is what the conditions are. What is the background that formulates the right conditions that this is such a strong company that even if the market does go down 5% in the next month, your stock can weather the storm and maybe still go up. That's, again, the test of a great strategy. Can you make money going long in a bad market? And can you make money going short in a good market? If you can say yes, I can't help you as much. But, I mean, you get my point. You've got to be able to have that. Conditions provide the backboard, and then indicators are the least important thing, because indicators are just there to confirm what you already see in the chart. Because if you don't know what type of trade you're doing, if you don't know what kind of recipe you're wanting to create, it's useless, right? Because the indicators that you use will be dependent on what type of trade you see. If you see an oscillating trade, momentum indicators will be useless. So if you see a range-bound stock and you start fooling around with moving averages and MACDs, good luck. But if you see an oscillating trade and you ignore those and start looking at CCI, Bollinger's, Keltner bands, Ichimoku, things like that, now you're onto something. You've got to know what type of trade you're dealing with. If you don't know what you're looking for, how can you ever get consistency? In order to get consistency, you want to do the same trade 100 times over and over and over and over again. And that's the whole game of trading. So once you know exactly what you're looking for, the beauty of that is you can build a scan. My business partner once said to me, if you do the same thing more than once in a day, John, can't you make a scan or technology do it for you? Right? That's efficiency, whether you day trade or swing trade. The amount of efficiency technology these days can give us is incredible. My objective each day, whether I'm day trading or not, is to spend 20 minutes of researching, 40 minutes setting up my trades. So about an hour a day is a max if I'm looking for day trades. If I'm looking for swing trades, it's a lot less. It's about 20, 30 minutes that I want to spend on research because I can analyze. I've got 4 strategies I use. I run my 4 scans every night, and what I see then is about 10 stocks on average for each scan. My job each night is to run through those 10 on each list and decide which, if any, meet my strategy. A question was, how frequently do we find stocks that meet the perfect storm? For each strategy, on average, over the last 5 years, 6 years actually, coming up, over the last 6 years, the average is about 12 stocks per strategy per month for a swing trade, and obviously a lot more when we're day trading. So before we go on to the next steps, because we do have a special class that we've arranged for the Trading Pub and with Morgan, it's actually the 3rd time we'll be teaching it ever, and we just actually finished teaching a group earlier tonight. It was absolutely awesome, and you can register for it down at Acorn Wealth Corp /scan, and I'm going to be actually showing you some of the stocks we picked with our scan here in a moment. But basically, September through December are perfect for trading. And yeah, I'll talk about the Forex here in a moment. But regardless of the markets, through equities and Forex, October through December has always been the best period for us, and shortly followed by January through May, of course. That's where we get the biggest returns. This is why we've decided to use this time frame as a launch pad to offer these types of strategies out to the general public. It's usually only offered to people who've done our 6-month intensive course. But as a group, I know that most of you are all intelligent people. You don't need to be taught what the S&P is. So you can kind of fast track this and learn basically what is a pattern that's effective and knowing when it stops working. For example, 3 times after a resistance is hit, it becomes useful. We'll teach you why. How to anticipate changes in the market instead of reacting to them. Like the head and shoulders we spotted on Apple when it was 680. We let all of our members know that it was a clear danger signal and a possible great short at 680. Everyone else saw the head and shoulders about 2 months later once it already had happened. You don't want to react to the market. You want to anticipate it. So the differences between triggers and conditions when building a scan will help you build your own custom scans as well. Don't go broke on breakouts. Learn how to avoid very, very easily spotted signs, once you know what to look for, this fingerprint I'm talking about, of when the market makers really are behind the breakout and when they're just stuffing around. How to search for high probability, low risk trades. It doesn't matter how much you make. It matters how much you risk to make it. So I'd much prefer to talk to the guy who makes 10% a month risking 1 than the guy who makes 100% risking 50. And of course, guy or girl, because I know we have a very diverse group, and but you get my point. And then, most importantly, with the strategies we actually teach you in this workshop, it's a really great workshop. I love teaching it. We always say it goes for an hour and a half. Tonight we went for about 2.5 hours because we just had so many questions. We went into flag formation, breakouts. I'll show you some stuff here if we get time. It was a really, really great group. And we basically give you, with each of these scans we teach you to develop, we'll actually give you a spreadsheet. One of the spreadsheets you get has about 12 columns in it saying, for the different strategies, saying, okay, what's the CCI doing? And these are what it should be saying. What's the market direction? What's the pattern? What's the volume? What's the smart money? And we basically give you a pilot's checklist. So before you make any trade, you can actually go in and put the values in for what your stock, where it's situated, and know whether it actually meets the strategy or not. How do we trade earnings seasons? Okay, I'm going to quickly show you this in a moment. I'll quickly show you the setup photos for the options, and then I'll, the workshop. So this is when the workshop is. It's a 2-hour workshop. Again, I say 2 hours. Tonight we went for 3. The time before we went for 3.5. I can talk till the cows come home, like Morgan knows. But we really want you to get great value out of it, so we'll stick around until you've completely got everything you need to go away and start trading with it. It's not a workshop where by the end we're asking you to go do something else and something else and something else. We're going to be able to give you a fully self-contained module you can actually go away and start using. It's only $39. It actually covers a lot of the material that we teach in our 6-month workshop, 6-month classes. And all you need to do to register for that is at acornwealthcorp.com/scan. It's a acornwealthcorp.com/scan. In terms of the Forex, this has worked very well. The guy that we actually hired as our Forex coach, I met about 3 years ago, and he was, I won't mention names, but he's one of the senior engineers for one of the major oil companies. We find that what we do, the type of analysis we do, works just extremely well with people with an engineering mindset. I mean, the amount of engineers we've had come through the course and do really well is amazing. Basically, he trades only Forex, and he actually entered a competition last year using our strategy. Had about, I think it was either 500 or 5,000 people. I think it was 5,000 people in, and he was coming second actually in the last 2 days, and then took his eyes off the computer and messed up an order and got disqualified. But he would have probably come first or second at least had he not have done that. He's a great trader, and he used this entire strategy only to get in there. So here's a couple of details. Yeah, and we are limited to 100 registrants just because of the type of meeting software we are using. We are upgrading. We've had 2 of these classes. They have sold out very quickly. So if you are interested, we will be keeping this open, obviously, to Morgan's group and the TradingPub group. But that's basically the setup and the time. A couple of that. So these are actually from people from our last event from TradingPub. Some of the reviews we actually got back immediately after that session concluded. So again, it's acornwealthcorp.com/scan, and we do record everything and send to you. So what do you learn in the 2 hours? Well, basically, what we're going to go through is 2 very important scans. We're going to go through how to develop your own custom scans. So anything you want to develop, things you want to find, you email that in prior to the workshop, and we'll actually incorporate components. So every group is different. If you tell us the types of stocks you're trying to scan for, we have a section at the end, which is why sometimes it goes longer, where we'll actually show you how to develop your own custom scans in whatever program you're using. We use Metastock, though, as our primary charting software. And what we then do throughout the actual course of the module is we go in and show you how to develop these same scans, one of the highly profitable scans for flag formations that I use every single day. We also, as a special right now, special kind of event, is we're going to be showing you the strategy of how to find highly profitable scenarios in option season, earnings season using options. Yes, we can use Thinkorswim, absolutely. And so with the option strategy, I'm going to show you this real quickly. This is awesome. I've got about 2 minutes left here. This is really, really cool. Is the course suitable for beginners, or do you need to be an experienced trader? It's actually suitable for everybody because we go through stuff that I had a veteran 15-year trader sit with me 2 months ago. He trades significant capital, over $500,000 daily in his day trading, and some of the techniques and coding and scans we developed for him is stuff he'd never touched before. This is one of the strategies you will learn. Is this on eBay? I'm just going to see if I can share this with you. We don't have the, well, basically on eBay, if you bring up a chart on eBay, it actually came right up to it was in a quick look here. So it came right up. It was in a descending channel like this, bouncing back and forth on eBay. Our scan found it here, and last Thursday it gave us an alert to buy puts on eBay. And those were between last week and today. eBay did gap down, and it actually had a 58% profit on those options if you bought them, the puts. So you'll learn actually a strategy on trading those earnings announcements, as well as our flag formation scan to use on stocks. So we're looking forward to working with you. It should be an exciting workshop. I've come to the end of my time. Hopefully you're still all wide awake. We've got some great speakers coming up next.